Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're going to review Dave Ramsey's 7 baby steps. And if you've never heard of that, that's basically his method of taking control of your money, paying off debts, and building wealth. And he says it works every single time with an exclamation mark. So, if you know anything about Dave, he doesn't like debt. He doesn't like lines of credit. For whatever reason, I'm not sure why. He always says a 15-year mortgage is okay, but no other debt is okay. So, step one is saving $1,000 for your starting emergency fund. Step two is pay off all debt except the house using the debt snowball. And then step three, which we kind of skipped to in the last video, is saving 3 to 6 months of expenses in a fully funded emergency fund. Now, I don't really mind all the 7 steps, but I'll tell you the one that's most offensive to me. Um, Number five, college fund. I would just take this one out completely because no one needs to go to college these days. You know what I'm saying? Take this one out. So everything else, I think it's okay. But let's just take a quick look at what he thinks about using home equity lines of credit. So there's an article here of what is a home equity line of credit. I'm going to skip a bunch of this, but he basically has this section about is it a good idea? And he doesn't say no. He says heck no with an exclamation mark, right? So a HELOC is not the stress-free way to start a new chapter of your life. It's not a shortcut. And by now, the HELOC funded retirement or home remodel, whatever you guys planned, doesn't sound that good. So number one, you're putting your home at risk. That is true, right? Because anytime you offer collateral to a lender, you get lower interest rates and higher limits. That's what a home equity line of credit is for. If you don't want to use your home equity as collateral, then you do use a personal line of credit, right? Number two, HELOCs don't really cash flow, right? HELOC is that I don't know what he means by that, to be honest, but we're going to show what our version of cash flow is with the HELOC. And then saving and paying cash is way smarter in the long run. Taking out any debt kind of robs you of your financial peace. And then he says, with a Ramsey Plus membership, you can get all the content and tools you need to save for the future, pay off debt fast, and build lasting wealth. Um, all right. So he says what to do instead of getting a HELOC. Um, if too much income is going to your mortgage, you could consider selling your home and downsizing to one that's more affordable. Right? Go to his Churchill Mortgage, Ramsey Trusted Pro. So it seems like his solution to getting out of a HELOC is just to sell off your property and downsize. That's what it seems like. Okay. All right. So let's go here. Let's just take a look at $1,000 for a starting emergency fund. And I always love to use this example with 10 credit cards. Again, your debt to income is pretty much all relative unless you live in Los Angeles. In fact, I read a study that said that your average Los Angeles person spends 75% of their disposable income on a mortgage. And to be honest, I have no idea how that's even possible because don't banks check for like DTI? Like I'm a little bit confused on that one, but let's just assume that we have $10,000 of income, and I know for most of you, you think this is insane, right? But again, this is just like a stress test of the concept because what you want to do is if you have a concept, you want to make sure that you stress test it, like in any other principle or science or whatever you're trying to teach. Okay, and I always show this example for that stress test in most of my other videos. So let's assume that you have $10,000 of income, 10 credit cards at $167,000. Now let's look at baby step number one, which is save $1,000 for your starting emergency fund. All right. So at the rate I'm going, right, $355 a month, that's going to take me 3 months to do. So do we want to wait 3 months to do step one? Or, well, should we do velocity banking? Number two, right? So let's say we do 3 months. And here's the thing I know that, like, when you pay off the minimums of the credit cards, like, I get it, like the each payment goes down, but it goes down slightly. So I still think it's going to take 3 months, and that's the trickiness with credit cards because the payment is always somewhat variable. Like it goes down little by little, whereas amortized loan, the payment stays the same throughout the life of the loan. Now let's go back here. So let's say we did this 3 months. We have $1,000 starter emergency fund. So this is going to be like 3 months, and then it's going to be like $1,000, right? Okay, now what do we do once we have that $1,000 emergency fund? Pay off all debt using the snowball method. And then what is the snowball method? That's pretty much looking for the smallest debts and paying those off first. So the smallest debt I see from this list is $5,000, right? And so if I'm paying $355, so have to wait 3 months to get the $1,000, and then I'm gonna have an extra about $300 every single month, and so that's gonna even take me more time, like 355. How much does that go like into 5,000? Well, let's just do this equals five, and I get there's going to be some inaccuracy because some of the debt's going to be paid off. But let's just say 355. 14 months? No, no, that doesn't seem right. Probably less than that. I'm just overestimating that. But again, so let's just assume it took like 12 months. That's about a year, right? So why don't we do this? Why don't we just do velocity banking? If you don't know what velocity banking is, it's an opportunity for me to put Dave Ramsey's face in a thumbnail so I can clickbait you up. No, I'm just kidding. All it is a debt payoff strategy where you can pay off debts using a line of credit as a main tool, and it's going to help. It may or may not help you pay it off quickly. I can't guarantee anything, but we assume two things, right? So instead of adding to our savings, like Dave Ramsey is telling you, we're going to go to zero, right? So this is a shocker for most people. Like, how can I have zero savings? Like, no, I need more savings. I mean, Dave Ramsey said I need $1,000 for my emergency fund, and then once I paid off all debt, and I don't know how long this is going to take me to pay off my debt, right? Oh my goodness, like how do I do this? Once I paid off all my debt, then I have 3 to 6 months of expenses in a fully funded emergency fund, right? So, and then no part of this equation, right? No part of this equation is a HELOC going to be involved. But let's just pretend we have a home equity line of credit at $200,000 limit. So you need to be a homeowner to do this, right? So if you have something called home equity, you could provide as collateral for what we call a line of credit, which is kind of like borrowing money and letting you pay anything you want, right? Almost like a credit card, but in some ways even better because a credit card, like with a home equity line of credit, I could pay anything, like credit card, mortgage, I can pay anything. But with a credit card, I can't pay another credit card. I can't pay a mortgage unless I'm using a third party service company like Plastique, right? So I can't do that. Okay. So now let's just do this. Okay. Let's go ahead and demonstrate the velocity banking concept. So a lot of people are going to freak out because how do we go from such little savings and you're telling me we got to go zero? Because the strategy is pay entire paycheck into that line of credit and then expenses out. Now, let's do this. We're going to move all of these credit cards into that home equity line of credit. And that's $167,000 of credit card debt. Okay? 167,000. Okay? And then guess what happens just by simply doing a debt transfer? These go to zero. And look at all that cash flow that's being freed up, even though we have no savings. So our expenses went from 9 grand to 4 without doing anything. We didn't follow the baby steps. In fact, I would say we kind of skipped the first step because we didn't have $1,000 emergency fund. Our $1,000 emergency fund is essentially our line of credit, and then we're maximizing our cash flow, but we're not doing a debt snowball. We're not paying the smallest at a time. What we're doing is maximizing our cash flow. Okay, so we just simply transfer all the credit card debt to that home equity line of credit. Now, what we're going to do is calculate our cash flow, which is income minus expenses, and look at that. We went from three. Okay, so on month one, Very first month, we went from 355 to 5,700, right? Remember when I did that calculation of saving up $1,000 in an emergency fund, it took us 3 months. But in the very first month, in the very first day one, we went from 355 to 5,700 without doing anything. And that's because we're using our home equity line of credit as our main tool. So let's go ahead and do this, right? So we're going to calculate the next month's balance and interest by using the strategy, which is paycheck into line of credit, entire paycheck into line of credit, expenses out, and then every single month the balance is going to lower by the cash flow plus the interest. Okay? So I know Dave says it doesn't really create cash flow, and that's if you're just paying minimum payments like he's talking about, right? Because he just says it doesn't work with your favor because you're just making minimum monthly payments. So we're going to put our entire paycheck into that line of credit, expenses out, and it's going to go down by $5,700. Whereas if we're kind of doing it the Dave Ramsey-ish way, well, I know Dave Ramsey doesn't like the word Ramsey-ish, right? But if we're doing the Dave Ramsey way, we would have just had to wait 3 months just to get that $1,000 emergency fund, and then just paying paying minimums every single month, right? So why not just go? Why not just cut the waiting time by 3 months and just go to 5,000, right? Why not? Why not just do that, month one or day one, right? So now let's go ahead and do this one more time. So we're going to calculate the next month's balance, which is the previous month's balance plus the previous month's interest, minus this cash flow right here. I'm sorry, yeah, this cash flow, which is 5701.35. Remember, the monthly payment of the HELOC doesn't matter because you're putting your entire paycheck into it, which already satisfies the minimum monthly payment, right? And it minimizes the interest because the interest is calculated by the average daily balance. So when you put the full power of your paycheck, average daily balance is lower than it would normally be, right? So now let's go ahead and calculate the interest, which is done by the average daily balance. So just estimate it with this average function, multiply by the interest rate, which is going to be about 10%, and then divide by 12. All right, so now take a look at this. So now you can kind of see, I just copy and pasted it. It's just going down, 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 down. And then by month 34, right, month 34, completely paid off. And it was a stress-free experience. See, here's the thing. I only just basically gave you one step. Well, maybe two steps. Paycheck in, expenses out. That's it. I didn't have to do 7 steps, and I definitely am not going to do step 5, which is save for college, right? That is the dumbest thing I've ever heard. All the other steps I think are okay. Step 5, definitely not, because college is a scam. All right, so let's go ahead and do this and just write our milestones. So how long does this take us? 34 months. And 34 divided by 12, that's 2.83 years, right? So 2.8 years it took us to pay off, was it 167? Was it 167? Yeah, 167K of debt. And again, it was a stress-free experience. Entirely stress-free. I mean, having to save up $1,000 in this model, right, in this way of banking, is a stressful experience, right? It's very stressful. But the fact that we went from 355 to 5,000, and that essentially that $1,000 is essentially baked in to our cash flow, so we kind of already did step one in a different way in day one. But this took us 3 months. This took us one day, right? So I don't know what side of the equation you want to be, but me personally, I think I'd rather be here, right? So again, I like Dave Ramsey, right? I think this is a sensible plan. Um, I think I mean, could it be better? Maybe. I don't know. I think for the vast majority of Americans would work, except for step 5. I'm totally opposed to step 5. Don't do step 5. Don't save for college. Ugh, it's a waste of time. But what do you think? Do you do velocity banking? Because I certainly do velocity banking, and I'm going to show you my latest HELOC. I'm going to go to YouTube. So give me one second. All right, so let me go ahead and go to my YouTube community. And so I'm going to go to community right here. And then you could kind of see my latest HELOC. And here's the thing, folks, I practice what I preach, right? So all my income in, expenses out, you get charged some interest, and then you have your new balance, which is essentially the calculation I made on this right side here, right? Income in, expenses out, some interest, and then you get your new balance. All right. Well, this is Korean Atlanta Mentorship. Just another opportunity to show Dave Ramsey's lovely face as a clickbait thumbnail and also showcase some velocity banking. If you're interested in joining our group, go ahead and click the Google form link below. Well, other than that, have a lovely day, and we'll speak next time.